Nice to be here.
Glad to have you. So tell us a little about what's going on in the commercial real estate market in Sarasota and Manatee.
Well, as Lisa was just saying, everything runs in cycles,
Mm-hmm.
and we've seen sectors of the commercial market hot, and other sectors of the commercial market not so hot.
Okay.
But our occupancy rate seems to be extraordinary. If you go across the board in commercial property, we probably have 95, 96, 97% occupancy in these commercial properties. But the rents haven't gone up because it's very stable. A lot of people aren't moving. You get a tenant, you want to hang on to that tenant. So in the retail business, driven by all the new construction as well, the retail construction has really increased the retail market for us. So the retail business is very hot.
Tell me about the commercial market as it relates to office space.
Well, office space has not expanded in our market, in our particular market, and office space in general has gone rather flat. As a matter of fact, it's down about 10%. But the reason for that is people don't use offices like they used to. You look at pictures from years back, and there are rows and rows of people that were working in an office. Today, you use the internet. Today, you use cell phones. You are doing things on the run. You're not coming back into an office to sit there, and you don't even have water coolers anymore. So,
That's true.
that's where that's at. So the demand for office has dropped. However, because we have education is big in our area, and healthcare is very big in our area, much of that office drop has been absorbed as a result of people needing to do that for healthcare and for education. So we have a very high occupancy rate in reference to our office space in Sarasota.
So tell me about what's going on in terms of the shared office space here as it relates to other places in the country.
Well, it's called hoteling, I guess, in a commercial business, they hotel space. So even offices of banks and things are using temporary space, and the real estate investors have got to repurpose these properties. So many of them are restructuring existing facilities into shared office facilities, and it requires them to add the infrastructure necessary to do that so that the tenants don't have to make all the investments they do. In New York, you're seeing immense buildings being converted into office hoteling kind of environments. And so that's happening here as well. And it's much easier for businesses, new business to get started. There's a lot of people who move down here who, after about 6 months, they get bored and they want to do something. If they've been in business before, they want to get back into business.
Right.
So we see a lot of emerging new businesses come up in our area, and that's a great opportunity for landlords and for the tenants to take advantage of this new configuration.
I understand that the property valuation per square foot on these kinds of shared office suites is very high because you're getting such return regarding the rentals. Is that true?
Well, yeah, the landlord has to invest in that infrastructure, but there's great return on that, and of course it carries a lot of expenses as you go with it that they can deduct.
Somebody told me that in the New York market that the turnover regarding revenue per square foot is 3 times as much on a shared office suite as it is on regular office space. Does that sound right to you?
Yeah, it does, because an office is kind of like an empty hotel. It isn't generating, it's got to have people in it to do it.
Right.
And so you really have to have traffic to make any of it work. I mean, traffic is the key to everything in the real estate business. So you have to have the traffic. And if you got the traffic, you're collecting more rent than that space normally would represent.
So a client comes to you and they say, what is the best investment in property down here commercially? What do you tell them?
Wow, that's a loaded question, Bruce. Well, typically, our clients have a portfolio to start with. So they typically will say, I'm very successful in retail, or I've done a lot of medical offices, or I just buy dirt. So, they have some experience to base on it. And I'm looking for things within this bracket, and this is the kind of thing I'm looking for. I got cows, I want to put them on dirt, that kind of thing. So I would say right now, the great opportunity that's being served up in Sarasota are the QOZs.
What's a QOZ?
I'm glad you asked. It's a qualified opportunity zone. Okay. And in the 2017 tax law, they put the QOZ code in for investors to be able to defer capital gains. And so if you hold a property for 10 years that you have in a QOZ zone, you don't have to pay any capital gains at the end of 10 years. So this is a great twist for us. And in Sarasota, Manatee, and Venice, we have some really unique QOZ zones. And they are not necessarily just in blighted areas. Economic blight is a horrible thing, and they're trying to correct that with this kind of program. So the QOZ zones range from waterfront all the way over to 301. And if somebody's interested in knowing more about that, that's an area that we specialize in.
That's very interesting. I didn't even know about that program.
Yeah.
Tell us about tax-free exchanges. What's going on in that sector?
Well, the IRS code is 1031. That's what they call it. And a 1031 exchange can, once again, defer or delay the payment of capital gains. And if you're able to defer that, you can keep your investment going. It can grow, and you haven't had to pay Uncle Sam his portion of it. Right. A lot of people like Uncle Pete, but a lot of people are afraid of Uncle Sam. But Uncle Sam can be very helpful in commercial properties because he has a number of incentives that he offers, such as operating expenses are deductible in it. You have depreciation that you can take on commercial property, and the deferral of capital gains is a big issue.
What happens if you want to make an exchange? You're exchanging one property for another. You want to exchange this property, but you have not located the other yet.
It typically requires an intermediary to handle it, okay. And you have 45 days to identify the exchange property.
Okay.
And then you have 180 days to close the sale on the identified property. If you miss that target date within 1031, guess what? You got to pay the capital gains. Right. It isn't like you're going to jail. You have to pay the capital gains.
Write a check.
That's right.
Okay, self-directed IRAs.
That's a great question, and I get asked that a lot. Okay. A self-directed IRA is just like a Roth IRA. If I won't get into all the explanations of that, but it's the same kind of vehicle. And a self-directed IRA means you can't blame anybody else. You got to blame yourself for a bad investment.
Sure.
So you have to be very careful what you pick. But commercial real estate, or any real estate, fits within an IRA, a self-directed IRA program. And if you have commercial real estate that is generating income, is got a return on investment that is good, that's a great thing. You could buy a bad deal, and if you have no experience in it, you ought to be very careful. I can't offer tax advice, Bruce. I want to make that very clear. I'm not a CPA, I'm not a lawyer, I'm not a doctor, I'm not your mother. So, so I'm just Uncle Pete in the real estate business.
Sure.
But you should talk to your CPA about that. And if a lot of people have a lot of money tied up in IRAs, and it's a way for you to really take advantage of the commercial real estate market. Okay,
so I know you're not a CPA. I know you're not your mother. Are there some things you can tell us about the tax considerations?
Well, yeah, the tax commercial real estate really has been the vehicle to use for taxes in the United States. And the first thing about it is that most commercial real estate, if not all of it, is income producing. Dirt might not be, but buildings in general are. So when you buy a commercial real estate piece of investment, you're really looking for what is the return on investment that it's going to be. And so the cash flow. and all those expenses that are related to that commercial real estate are deductible off your taxes. You're also not being penalized as a FICA payroll. So if you're an investor in commercial real estate, you're not involved in self-employment tax. And self-employment tax is like 15 point something percent.
I think it's 15.85. Yeah.
Well, it's high.
It's high.
And if you're self-employed, you got to pay all of that,
Right.
where you would be sharing that with your employer otherwise. So in commercial real estate, you avoid that in deal. The other thing is on commercial real estate is depreciation. That really is a gift. And of course, depreciation on commercial buildings is 39 years. So that's a long time.
Sure is.
And residential is 27 point something years.
Right.
But 25?
27.5.
27.5. Thank you, Lisa. So
Okay.
that there's a difference there.
Sure.
But you can deduct that from your income, and that's a paper loss. It's not a real loss that you have to look at. The only problem with that is when you go to sell the property, you may have that depreciation recaptured.
Yeah.
And a recapture on that is about 25%.
Right.
However, if you didn't make any money on the property when you sold it, there's no recapture.
Sure.
So you're really getting a gift from the Internal Revenue
So
Service.
you're generating cash flow using the IRS
Absolutely.
during that period of time, which is a very nice thing to do.
And then, of course, the last piece of it is really capital gains.
Sure. So let's talk about the estate tax issue as it relates to commercial real estate. Tell us about that, how that
Well,
works.
that's a big plus right now. The tax law, again, the new tax law 2017, raised the limit in reference to estate tax. And if you own a piece of real estate and you pass away and you pass that on to your heirs, they are not going to have, that's going to be their cost basis for that property. They're not going to have to pay what you paid. They're going to have to make the difference there.
Right.
That's a big advantage. Also, most people won't hit that number, but it's $11 million is the amount that if you're under $11 million on your estate, there's no taxes on that as well. So real estate is a great investment for estate planning.
How are properties being financed now?
Well, as Lisa said, in Sarasota, in this area here, cash is king a lot of times.
With commercial property as well?
Well, sometimes. Most real estate developers want to use leverage because you can deduct all the interest. You can do that kind of thing.
Especially when you have the depreciation, you're generating some
Absolutely.
cash flow. Sure.
So they're really good tax hedges, if you will. But there are a number of different loans available. Primarily, real estate is a commercial loan, and if it's a commercial mortgage, you're not going to get as much leverage on a commercial mortgage as you would on a residential mortgage, because commercial mortgages are not guaranteed by Fannie Mae or Freddie Mac. So those are they're not really in the equation. The government's not giving anybody a break there, is really what it amounts to. So there's less amount that you can finance typically. It's going to be driven by the net operating income. And that's going to be part of the predictability, in addition to an appraisal that's going to match your loan to value as they go through it. But a commercial loan, commercial mortgage is typical. Most of the commercial banks offer them. There are bridge loans that you might be trying to put a deal together, or you're trying to roll up a certain series of different properties. And then there's also SBA loans. And an SBA loan really lays on top of a commercial loan. The SBA doesn't give a loan. They guarantee a loan that a commercial bank would issue for a commercial property. So you can apply for an SBA either in a 700 series or a 500 series, depending on what it's looking for.
Right.
So the SBA is a good option for people who are just trying to get started in this. There's restrictions, of course. That's all part of the deal. But you got to know what you're doing before you get into it. So commercial real estate is not like walking down the grocery store. It's illiquid. Your money's going to be tied up.
Right.
but there are ways around that.
So you've just given us a mini course on commercial real estate.
Well, very many.
What else would you like to add?
Well, I'd like to indicate there's one other way to get your money out of an illiquid investment like real estate. And that's pretty much a good story of that would be what the Rockefellers did with Rockefeller Plaza. When they built the Rockefeller Plaza in the 30s, you know, it was an enormous undertaking, cost millions and millions of dollars. It was the most premier property out there.
Right.
It still is. And it has gone up in value over and over and over again. And the Rockefeller Trust has borrowed money over and over and over again as that value has gone up. Have they paid taxes on that?
Oh.
No, because they haven't sold anything. They've, in effect, refinanced it as they go along, and they can use that cash to either fix up the buildings or buy caviar, whatever they happen to want to do. It's their money.
Sure.
And that's one of the ways that people find liquidity in commercial real estate.
How can people reach you?
Well, you can go to Peter, that's me, at myunclepete.com. And after all, I am your uncle in the real estate business. So that really is how you'd be best to get me. My website's My Uncle Pete as well. And I'd be more than happy to just drop me an email and we'll get together and talk about it.
I'm sure you'll get some of those.
That good. Thank you, Bruce.
Thank you. You guys have been wonderful.
Thanks a lot.
Peter, how are you, friend?